Okay, welcome to the Capital Discussions Market Analysis. Before we get started, we have our standard disclaimer that this is for educational purposes only. We don't know you or your situation, and Capital Discussions is not an investment advisor. We don't have any way of knowing what level of risk is appropriate for you. So with that disclaimer out of the way, we'll get started, and we'll go over technical analysis and fundamentals of the week that just happened, and then we'll look at what's coming up next week. And after we go through that, we'll have a discussion on volatility and talk a little bit about UVXY. So, Jim?
Tom, I'm going to get started in a second, but you forgot to tell the folks this week that you did what I thought was an excellent presentation on understanding how puts and calls can actually be used in lieu of one another. Some people call that
the synthetics, right?
Yes.
Yeah, I posted that on the on our website and the blog and also in the forums, but it was a good discussion. We both you and I were at Options Tribe with Seth and had a nice presentation at the end where there was a really good discussion about execution as well. So we had some good comments that people enjoyed that part almost as much as the presentation.
Yeah. And if you take a look at it, it's available on the website. Tom, how do people get to it? Could you just walk me through so I can see the presentation from here? Do I start from? Should I go through
actually,
the forum?
If you can go through the forum or through the main site. If you click on Home there, and then go to Articles.
And here
and then on the right side, you'll see the latest articles. What you don't know about synthetics can hurt you. That's the article, and I've got the video posted there with the slides. So right underneath that live vol thing.
Right here.
Or yeah, that one right there. If you just click on the
title. And it's also at the top, and it's right here. Okay.
Right.
And if you get a chance, if you're not real sure about, how a put might be different than, a naked put would be different than a covered call. Tom kind of goes through it in the video. Really, really, really strong set of slides. I think it's one of the things where, when I first started, was very, very helpful, and Tom ends up walking you through it. Did a great job on the slides, and I suggest you take a look at it. With that, what happened this week? What I'd like to end up doing, as we always do, is that I'll take a look real quick at the economic calendar. And the economic calendar on our website that, again, Tom had put together. You can end up getting from resources, calendars, and I look at the economic calendar. You can also look at the international, which I do, and the earnings. But most of the stuff comes from the economic calendar. There were some interesting things that happened this week. One of the things that I always take a look at is how did market react to certain types of news. The thing that I love, by the way, about our calendar is that I can go back and I can take a look at, here is the S&P 500 futures. Okay, by day, the dark area is when the market's open. The lighter area or shaded area is the overnight sessions. So obviously the market's only open a few hours during the day. So I can see what ended up happening. So the first thing I'd end up taking a look at is this is right here is Monday. Okay, you can see the first day here is Monday. Here's Tuesday. As soon as the market's opened, it sold off. Very weird that, it just as soon as the market's opened, we just sold off all morning, okay, until late morning, and then buyers stepped in. What happened on that day? Well, what I end up taking a look at on this is that I'll go back and I'll take a look at market reflections, because when I looked at the economic information during the day, there really wasn't anything here. By going back and looking backwards underneath market reflections, you can end up seeing there's just a small paragraph, but basically what it says is economic data was reasonably well. We've now mentioned, okay, this is the third week in a row, that they refer to some of the comments that some of the Fed presidents, the regional Fed presidents have made, and they said that interest rates might be going up soon, sooner than some people expected. So the market ended up trying to take profits. Okay, so when I come here and take a look, well, large institutional hedge fund managers can end up trading futures, but most are trading, the larger money's trading during the day. This was large money in big volume saying, oh, you know what, maybe it's time to start to take a little bit off the table. They only took a little bit off, the selling came down, and we ended up driving back down. So it was kind of interesting to see how the market reacted to it. It's telling me that we're not in this unidirectional, only the market goes up, like we have for nearly 2 years now, that there could start to be some two-way volatility. That was pretty much the most important thing that happened, during the week or so. So I thought, if I come back to the calendar, there were the Fed minutes that came out on Wednesday, and there was some noise around it, but not a lot. The interesting thing happened was overnight on Thursday. Now, there was no real news that it moved on. And here, let me show you back in the graph. Around 1:25. I happened to be up real early that morning, and I was listening to the news, and their first comment was that Bullard, one of the Fed presidents, made some comments that interest rates, are not being hedged properly by some institutions, and they think that interest rates are going to stay low longer than where the Fed ends up being. Well, we talked to you guys about that 2 weeks ago, right? When we said when Bullard and some of the other Fed presidents came out with things, how did the market react? It immediately sold off, but it came back up. And I told you, hey, these are signs that at some point this is going to become real. This was institutional, larger institutional money saying, yep, it's real. The economic, you told us, and they're saying about the Fed told us all that if economic data gets to be too good, we're going to start to raise rates sooner than some might expect. Well, that was economic data being good, and this is the first time probably in a 2-year period where good news was bad. I always take a look at how the market reacts to things. Sometimes the market for the last 2 years, if we had good economic data, the market went up. If we had bad economic data, the market went up. Why? Because the Fed would keep interest rates low. This was like my first hint where good economic data was bad for the market because they were afraid that interest rates would end up going up. But it was no big deal, right, because we climbed back to right where we were beforehand. And then overnight on Thursday, we started to sell off. I was up real early. I was listening to news. I was reading Bloomberg, and they said, and they actually referred specifically to the Bullard comments, where interest rates were too low. And they said that was the sell-off. And I was like, I got to call BS on that one. Those comments were made a week ago and 2 weeks ago. That really didn't count. And then the next thing, that they end up saying, well, there was some bad economic data that came out of China. And I looked at it, and it really wasn't that bad. Plus, also the thing is that any numbers that come out of the government from China are always taken with a grain of salt. And then they end up saying, well, and this was a bigger one, the second largest bank in Portugal was late on a payment, which put them in technical default. And now here's the problem with this, The U.S. markets aren't open. Europe, it's kind of like, the kids are running amok because the parents aren't open. The European and Asian markets are running amok because the U.S. markets aren't open. Only the futures markets are open. And here's what I ended up going to take a look at. Some time ago, what we ended up looking at is that we ended up having on the Bloomberg interest rates, and I don't know if I have that up. I guess I don't. I wrote over it. But I'm going to take a look, and I'll show you underneath Bloomberg International. It'd help if I could spell properly. Interest.
Jim, while you're talking, Tony Sizemore's joined us. So for those who don't know Tony, he's Jim and I have known Tony for a long time, and he's got Option Elements running that, but he's here to help join in with the conversation.
Welcome.
Thank you, Tom.
Welcome, Tony.
Hey,
Jim.
Jim.
One of the things, Tony, that I was taking a look at, now I don't know if you used to do this, but going back a year ago, I used to end up looking at the Spain and Italian interest rates, because those were the two countries that were much bigger than Greece, and if they ended up falling in Europe, it was going to end up being this huge issue. This was before the ECB was out doing their own version of quantitative easing and buying bonds, and now each country had to stand on its own. So we were really worried about Spanish rates, and the Portuguese rates went way, way up. And when this happened overnight, now Mario Draghi, okay, and the rest of the ECB, I always found it kind of funny, okay, when Draghi was doing this, and say, well, what's his real intentions of the markets, okay, in terms of going out and buying bonds, and is he trying to support the markets? And I realized I never had to look further than the spelling of his last name. Go and take a look at the spelling. It's spelled drag high. Okay, that's the way he spelled it. So it was pretty easy to figure out what he was trying to do. But when I take a look at the Portuguese rates went up to 3.8%. Okay, so when I go back to this sell-off was because of you would think that the rates should be a little bit higher. So that was the first thing that started to end up saying, well, I don't know if that's the real reason, are they overreacting? And so where I end up going to take a look at where people are overreacting is I look at this chart on Thinkorswim. What I am looking at, and I know it's a little bit complicated, but I'm looking at a 5-minute chart over the last 2 weeks. And there are 4 things being plotted here. The one on the bottom is the VIX cash. The second line here, this more lighter pink color line, this is the front month futures on the VIX. Then the second month futures, and then the third month futures. Now, when we had this jump up here in the VIX, on that morning when the market opened up, right? We went from 11.6 and we jumped all the way up to 13. I mean, that's a big jump, but it's not like it was huge. When I take a look at how much the futures moved up, they too moved up, but again, it wasn't that significant. If I go to the third month, it was even less. Let me give you a point of reference. Year and a half ago or so, April 15th, on the day of the Boston bombing, the VIX moved up a third. It moved up 33% in a day. Okay, and that was for, yes, there were some bad Chinese numbers that day, and there were a couple of other minor things, but it really, when I take a look at how much we moved up on the VIX here, it wasn't showing me that there was real fear in the market. One of the things that I look at all the time, and I know that one of our listeners ended up pointing this out, and we put it up, is that I take a look at a website called VIXCentral.com. And this ends up showing 15-minute delays, but it's free, so I'll show you guys this stuff. I like to show you free resources. This shows you how expensive each of the VIX futures are trading. Here's the July future, here's the August future, and so on. And this is real time, and it's 15 minutes delayed. This is a normal curve. When you go from lower left to upper right, meaning that the shorter-term shorter-term futures are less money than the longer-term futures. This is a very normal environment. We call this, by the way, contango. Okay, it's a 2-bit word so that it makes everybody more confused. But all it says is that the shorter-term futures are cheaper. This number right here, and I kind of like the way he set this thing up. This 4.27. I look at that number real time, but I look at that number, every single day. That number is how much cheaper the front month future is versus the second month future. Because if there's fear in the market, the front month will go up much more than the back month.
Jim, can I just ask you a question that probably some people are thinking, because obviously I'm sitting in a trading room with two of the smartest guys I know, and I'm not quite as smart as you guys are. So can I ask the question that maybe
us to them?
some that would be Tom with the big brain. What they call you?
I was only joking.
And that would be you, of course. So I have a question. I mean, basically, I think you're laying out the case really, really well, that the fear is not quite in the front, month or even the back month yet. Do you believe that the fissures are in the market and the crack is about to occur so that we will begin to see sustained longer-term higher implied volatility, which goes to your other long-term trade, which you're going to talk about? Is that what is that what this data is really telling us?
Yeah, it is to a degree, definitely. And I can't end up telling you when it's going to happen. Nor will I try to ever make any type of predictions. I forgot who ended up saying, but one time said predictions are extremely hard to make, especially of the future. What I am saying, and what I'll look at, is that I want to look at the underlying indicators that are going to tell me, yes, there's real fear in the market at this point, and we need to start to end up worrying. Are the cracks already in there? The answer is when you take a look at any of the longer-term fundamentals, things like, I don't know, I'll give you a longer-term one that I end up liking. Shiller's long-term, multi-year earnings. Right, when he takes a look at price per earnings, it's called CAPE, I'm sorry. And we ended up referencing this, I think it was either last week or 2 weeks ago in our review, and I ended up showing some of that. It shows that we are at multi-year highs. In fact, if you take a look at that cap, you'll find that we're at the fourth highest time we've been during the last century. We were higher in 1929. We were higher in 2000, and we were higher in 2007. That's it. Those are the only 4 times we've been higher. So
yeah, I think that's a good metric.
Right? To be in this market, and there are a bunch of other things too, because Tom and I read a lot of things, and we know that the markets are extended. But we also know just because they're extended doesn't mean they can't be even further extended.
Exactly.
One of the things that I read many years ago in One Up on Wall Street, I don't know if you ever read that. That was manager of Magellan. Why am I drawing a blank, guys? Who managed Peter Lynch? Peter Lynch wrote in his book One Up on Wall Street. He listed out the 9 most common mistakes that investors made, not in any specific order, but one of them was the market or the stock price has gone up this high, it can't go any higher, and the very next one was the stock price has gone down this low, it can't go any lower. Oh, yes, they can. So while I have thought that the market has been overvalued for a year, doesn't mean that it's going to end up not continuing to go up. And here's the biggest difference that I think that the 3 of us all end up thinking. We're not trying to make this prediction. I'm going to trade the markets that I see, not the markets that I think should happen or the valuations that we should end up happening. One of the things that we ended up going over last week, Tony, was that we took a look at how expensive the calls were above the money on the indexes like the S&P 500 versus how expensive the puts were an equal distance below the money. And what we found was that difference between the two, what a lot of people call skew, we were at multi-year highs, meaning that people were willing to end up paying much more for the puts in relative terms compared to the calls.
Well, the calls I've noticed in at least in the major market indexes, without talking about stocks, the calls are, really relatively cheap. There's no real implied vol premiums in there, and that's where, if you're selling those, you can get really hurt on a sustained move to the upside. And I don't know. I mean, maybe the prices of the puts, since they're they're higher. I mean, one thing that tells me is that people are a bit nervous about a pullback in the market. But I've noticed only one exception, and maybe Jim, maybe there was more, but the only time I've ever seen a blow off top in a stock in a major market index for stocks was in the Nasdaq,
Yes.
way back in the 2000s. That was a what you would consider like a commodity blow off.
Now, were you trading options back then on the Nasdaq?
I was not.
Here's one of the things that happened during that time. The calls actually got to be more expensive than the puts.
Yeah,
that in my mind is the definition of a blow-off top.
Yeah, I agree. It's interesting that we've had this low implied volatility environment for quite a while now. Obviously, you're talking about the volatility measures. We're not talking about individual stocks and their characteristics. But when you go to that chart right there, again, I think that what we really want to know is, or have a good handle on, should we be, at least neutral Vega in our trading and not be reliant so much upon negative Vega trades going forward for the next, year.
That's a really good point. And if you can be, I think that now is probably as good a time as I've seen in, many, many years to be that. One of the things that also people don't end up taking a look at in terms of their options trades is that the steepness of those puts, meaning how expensive. Here, let me just pull up this here, and we'll take a look at the SPX. And I'll come over here and take a look at, when I go and I take a look at, let's just use maybe 20, we'll go out a month. I'm looking at how expensive the implied volatility is and how much they go up as we go down. In terms of, take a look at the implied volatility of the 1920 is at 12.65. At the 2000, we're only at 9.1. We did a whole presentation last week on implied volatility. These charts in Thinkorswim are a little bit tougher to see. I don't have it set up now because we did it all last week. We went through and we took a look at how expensive those puts are in terms of, and how much steeper they were below the money on the puts. And yes, you can see that they're really, really steep. Now, the challenge is that if we do end up coming back in, the implied volatilities can get very high very quick. So how do you end up protecting yourself? One of the ways that, and we have this trade on, I'm sorry, I have it over here. We have this trade on in the SPY through my investment company. We had built some hedging where, and let me bring this out a little bit. Take a look at where our Vega is. Okay, we end up having some pretty, we make sure that we are long Vega all the time right now in this. And the reason why, and the way we end up doing that is this is $1 million of S&P 500. What we'll end up doing is we sell some covered calls, and we kind of do this ratio calls put spread. But I want to have trades where I'm going to be long Vega in case we end up having any type of hard pullback. So here's one of the things that I end up looking at all the time, and I happen to be in Thinkorswim, but you can do the same type of thing, okay, in LiveVol. That's the other trading system that we use a lot of. I'll do my volatility steps. Have you ever done this where what I'm looking at over here, and look at the numbers, this shows me what my implied volatility is if we go up in 4 separate steps, 5 volatility points per step. So if we pull back, how far do we pull back? Does VIX go from, you can see the numbers here, that they're 11.95, and then each one of these going down. Red is...
Yes, so how much is implied vol going to actually go up on a decline? And this represents your theoretical values of your position based upon, what is that, 5-point increases in
5 points
in vol?
increases is what I have it coming down. So if I end up taking a look, and let's say if I made, this is 10%. So if we wake up tomorrow and we have dropped 10%, could the VIX possibly go up to 32? Well, let's say if we got there in a couple of days. Well, if we dropped that far and there was fear, 32 VIX is not, a level where you'd say, oh my God, it could never happen. I mean, it's pretty, do we get to 26? If you take a look at this, the way we have this portfolio set up is that we drop, and let's say the VIX only pops up to 26.9, okay? That's the yellow line, okay? Instead, on the $1 million portfolio, down 10%, we're down $24,000, or let's call it 2.5%. So the way we set up...
Which is not much because of the fact that you're long implied vol on the way down.
Right, and so that's exactly the way. We try to set up those trades exactly that way. And so when do I start to end up worrying? And the reason why I end up starting to worry, and back up. If I come back to the chart here, what happened on Thursday morning, right, when we ended up having this sell-off here.
The continued drop.
The continued drop. The market was open. When we had this drop overnight into Thursday morning, to me this told me a lot, because here's what when we had this drop, the market was already open. This was larger hedge funds, larger mutual funds, pension plans that said, hey, we've had a really good run. Let's maybe take a little bit of money off the table. They can't sell overnight, right? They can only sell when the market was open. This happened after good economic data. This drop happened overnight because of, some minor incidents. What happened as soon as the U.S. markets opened? We basically went up.
Stabilized and rallied.
So what happens is as we start to open up here, I take a look at what was going on in terms of the VIX and the VIX futures. If it's easier, I just set this up on Thinkorswim, but if I take a look at this over here, this was Monday's implied volatility, or the trading levels of the VIX futures for each month. So this going back is in normal contango, and what I'll do here is I'll show you what happened during the week. This is what the curve looked like on Monday. Okay, the yellow line, and you can see right here what happened on July 8th, what happened on July 9th. Now 10th, this is the day, right? This is the day when all hell breaks loose. We're still in contango by 2.5%. During the morning, we got down to 1. We were never negative. At no point did the front month futures get way above the second month. At no point did the VIX cash get above the futures that were at least 30 days out. Those things have to happen if there's going to be any real fear in the market. When Tom and I were talking on Thursday morning, I was like, they kind of have to show me. Right now, the market's not down enough, that there's not enough selling pressure that I'm going to get really worried about this thing. They're going to have to end up continuing to sell this thing off before I think that the pullback's going to end up being taken more serious by larger investors. And sure enough, what happened, by Friday? We started to come back down again. Okay, that's this mustard-colored line, if you can see it here. So we actually got our contango to be back to 4%. I watch this every single day, and I'll tell you over the last, half year, I'd say from mid-February on, right, because we had that pullback, in late January, early February. Contango's been around 5 to 8%. We move a little bit above it, a little bit below it, every day. So we're back to practically normal at this point. Am I fearful that a sell-off might happen? Yes. But they have to prove to me that real money is scared. Until then, when we take a look at things, it's kind of just business as normal. Plus, we're also in the summer, okay? It's the first weekend after the 4th of July here in the U.S., so markets tend to be a little bit slower. I need to see a catalyst, and then I need to end up seeing the cost of insurance, right, the implied volatilities of the larger products on the indexes, not individual stocks. I need to see that show much more fear. Yes, the puts are more expensive than the calls, but they're not jacking anything up at this point. Not significantly. Okay, not significantly. If you take a look at the 2-month, option on the 2-month future, I mean, it's hard. And I told you there was this huge drop. You'd look at that chart and say, well, okay, maybe here, but it really never really jumped. Same thing with the futures going out. That's 3 months. The blue line is 2 months. Yeah, you can see it a little bit more in the 1 month because it's going to be expiring. By the way, the 1 month expires on Wednesday morning. So that's almost the cash at this point. So anyway, that's what we ended up seeing. That's what we ended up thinking about what was going on with the market and why we considered Thursday, not that we trade the markets, but that was actually more of an opportunity to get long than it was to panic. So anyway, any other questions or comments?
I wanted to ask you a question, Jim, about the longer term, VIX trade, the implied volatility. I forget what your symbol is that you're using. It's the VXXY or the
UVXY, I think.
UVXY, yeah. A lot of people would like to get long this particular trade. I don't quite understand which instruments I would actually use to get long. The inevitable. I mean, it may not happen. I mean, the Feds may actually, be able to taper on off. Business might pick up. They might have some magic bullet that prevents the market from having a correction. But I just think that like from an anecdotal level, we've got some boots on the ground in Spain. We have a partner that runs our Spanish division. He lives in Spain. And anecdotally speaking, he talks about how nobody over there, businesses in his orbit, are doing anything. They're just sort of hunkered down. They're not really spending. There's the economy's stagnant, and so forth. And I suspect that that's also the same in some other areas. But this particular contract right here, it obviously has the potential to go, exponentially in orbit. So what is the longer term trade that you would do with this? The difference between the various implied volatility months to take advantage of a potential rising vol. How would that occur?
Okay, this is it's a great question, and you have to end up realizing that ETFs are created to end up making money for their creators.
Yeah, I know.
When you look at, I'd say the same thing. People talk to me about CNBC. No, CNBC is on there to make money for their network and their shareholders, and part of not to end up helping you to make money. They need you to end up watching, and they need to be able to end up generating enough revenue from their viewership, through their advertisers to make money. This particular product. And here's what's the most interesting thing about this, Tony, and it's a great question because I think it's probably one of the most misunderstood things in investments today. If you were to trade a future, right? We were talking about the VIX futures, 1 month out, 2 months out, 3 months out. A futures contract, you're not actually buying the contract. You're buying the agreement to buy or sell the specific thing, in a certain period of time from now, without any option. It's a contract. It's definitely in place. Think about where they started, 150 years ago. They started in the grain pits in Chicago, where farmers would go to sell their corn, okay, before it came out, because they didn't know if they were going to have a drought or if it was going to be too abundant. So it was a way to be able to hedge what price you would end up being able to sell for. And the reason why I just wanted to end up making that comment was that if you were to end up buying corn or any of the grain products, gold, the S&P 500, the E-minis, Treasury futures, every one of these things, if you so chose, you could trade the future against the spot price, against the cash. You want to do it in gold, we can do it in gold. You want to do it in silver, we can do it in the S&P 500, we can do it in the 30-year Treasury. You can't do it in the VIX. If I told you, go and buy me the VIX, where would you go and buy it? You can't. Why not? Because it's actually a derivative. What is it a derivative of? It's the calculated price of a 30-day implied volatility on an S&P 500 option. It's not a tradable instrument. It's a calculated instrument from the SIBO. So how do you actually end up getting people to sell this stuff? Well, here's the problem. The problem is, and I'll go back to this chart because I think it's easier to see. If I ended up showing you, here is a contract that expires in July, and here's one that expires in August, and I should be up here on this line. This has 38 days left to go. You see that where it says 38 days? And this one here has 3 days. If you let me do this as an example, let's make believe that one contract had 15 days and one contract had 45 days. The only way to kind of emulate the VIX, what the VXX does, is they do it using futures. So if we had one contract, the front month contract had 15 days, and the second month contract had 45 days, we could say, well, you just buy half of each, and we have an average of 30 days. And that's what these products do. The VXX I'm talking about specifically, and there are others, but it's probably the most commonly traded one. So they'll use the futures. Now, here's the problem. What do they do when the market opens, okay, tomorrow? And I know it doesn't open tomorrow, but when it opens on Monday, you're only going to have 14 days and 29 days, right, because each of them are going to be 1 day older, which means they're going to have to sell some of those front months, which are only trading at 12.64, and then they're going to have to end up buying some of the second months that are 13.18. What's the difference? It's what I told you I look at. It's the 4.25% approximately. So every single day they have to end up rolling some of the front months into the next month. And by the end of the month, they have to end up rolling all of them. That means that the VXX, I told you since February, that number has been between 5 and 8%. That means they have a 5 to 8% drag on them every single month. So
because they're selling their contracts at a lower price than the ones they're buying continuously day after day, which causes that drag.
Exactly. So they have this huge drag. Now, only when we get through times of fear will that front month get up to be higher than the second month. Now, when that happens, it can spike dramatically. You know, one of the things that I ended up doing is that I built these, I I built a couple of different indicators. Here is the VXX since it was first implemented, okay, and it first came out. Now, you want to talk about the timing of really good sales guys. I mean, these guys were freaking brilliant, because let me end up showing you a chart that I ended up building here, and it's the, I'm sorry, I would have had this ready had I known the question was coming. I guess that's what happens when you do things live. Okay, edit, and let me get rid of some of these things. Okay, that's going to be easier to see. And then let's come over to here, and let's take this out, not 2 years, but let's go 10 years. Okay. Here is this white line is that VIX form, it's that VIX ETN that I showed you, the VXX. Look at when they brought that to market. Early 2009. Why everybody wanted to buy it. Okay, they're really smart guys, right? Because they're selling this stuff. They took it. This is what happened with the VIX in late 2008, and people still, you know, they got the crap scared out of them. So they bring this to market in early January 2009. Right? Absolutely great timing and marketing effort on their side. Then what ended up happening was that you know how there are some leveraged ETFs, the 2X, okay, the double bull and the double bear? Well, what happened was that right over here in 2011, when Congress couldn't decide to make up their mind whether we were going to pay our bills or not and extend the debt ceiling, and we got the U.S. got downgraded, okay, by Moody's. Okay, and the VIX shot way, way up. Okay, we're talking early August 2011. This is when they came out with the double leveraged. Okay, that's the UVXY. Now, these things will have this constant drag on them. The problem with them is that when they go up, they can go up pretty dramatically. Let me show you what happened here. Right, we're going to highlight. See that colored area? We're going to end up focusing on that, and I'm going to highlight that. Look at what happened with the VXX. The VXX, now this is split adjusted, right? It went from 300 to 700. It more than doubled during this time. Now, oops, I'm going the wrong way. Now, what do you think happened if I zoomed this thing all the way back out? That was with this little thing. It went up 2 times, or 2.5 times. What do you think would have happened if we went over here? You know, I've actually done the math to calculate the VXX going backwards here, and the answer is that it went up about 600%. So it can go up absolutely huge if you get into backwardation. Now, remember what that was. What backwardation is that when you have the front months being more expensive than the back months on the VIX futures. Let me give you an example. You know what? Let's clear all of this stuff. You know what? I'm going to close it and open it. The guy who ended up building this was nice enough to actually put, if you end up ever choosing the history button when you first click it, he shows you the day where we were in probably the worst backwardation I've ever seen in my life. Look at where the front month is. Front month is 63. The second month, if you take a look at the date, October 16th, 2008. Do you remember? We all thought that the world was going to die financially.
I was watching TV. Well, it may not have been the exact day, but I was watching CNBC. I had a massive NDX condor, and I was going, oh no, they're not going to pass the stimulus. And I'm looking at it, and it's going closer and closer, and all of a sudden I'm like, they're not going to pass it. So I run from the TV, I run over to my computer, and it was too late. And I had to bail at extreme prices. I think NASDAQ went down If that's the particular day, it might not be the particular day that they were doing that.
I don't remember. I don't remember the specific
It was
day.
120. Yeah, it was 120 points in NDX, like within 2 minutes.
It was amazing. As the vote was coming in, it was the only day I saw every single television on trading floors, okay, around the world. Usually we have on Bloomberg or sometimes CNBC in the background. Every single one of them had on C-SPAN watching the vote.
Yep, I was watching it. It was coming in. I thought they were going to get it, and I suddenly, in a panic state, realized that they were going to be short the vote. And by the time I figured that out, sitting in front of the TV and went to the next room where my office is and grabbed in front of the screen, it was over. I mean, it was oh my gosh.
I wish I could claim that I could do this, but I didn't. At the time, it was my trading partner, Stephen Shannon. He too had on iron condors, and he couldn't get the put spreads off at the time.
No, I couldn't
because nobody would trade spreads.
Nobody was.
Markets moved too
nobody
fast.
was buying them. I mean,
nobody's buying them.
I mean,
so
selling them. I mean, I was trying to buy them back, and nobody was selling them. I mean,
nobody was selling. So because no spreads were being executed at all. So he tried to do it, couldn't get it filled, so he did the next best thing. You have to put in single orders. He bought back his short.
Yeah.
Except for his TV wasn't in the next room. It was right next to his computer. So he did buy back his short. And when it continued to fall and continued to go down, all he had on was his long put underneath.
Well, that was good.
Oh, beautiful.
Oh my God! I mean, it was brilliant. It was absolutely brilliant.
It was a mega lesson in massive increase in implied volatility. And I think that your presentation today about what can happen with implied vol, it is good. Obviously, for individual indexes, if you have index options and you're trying to set up, sort of our singular or combination strategies like diagonals or calendars or, various things like that, ratio spreads. I think that's one thing, but this whole idea about, taking advantage of the volatility indexes themselves and waiting for, the next big pop, I think that the risk-reward ratio on that is tremendous. I just don't know which one of the instruments to actually trade. I don't know if I should buy, just outright one of these products, or if I should have a spread on. I'm not familiar with, the various different.
As scared as I am, as concerned as I am about the market, as much as I want to end up saying I need to end up being long volatility in terms of a trade itself, I will keep at least on the majority. I've done two things in the funds that we end up running. The first one is our normal index income trades, things like iron condors. Those things have gotten smaller and smaller and smaller, and I will tell you that right now I do not have any on. And the reason why I don't have any on is think about your iron condor. You're selling a put, and then you're buying a put further below it. I go to the indexes here, and I end up showing you what ended up happening with here, and I come to analyze, and I look at the trades. When you're selling a put, and then you're buying a put below it, the steeper that put skew, right, meaning the steeper the IVs are, the higher the IVs are, the further you go below the money, you're buying a lower IV and selling a higher IV. Okay?
No, it's the other way around, right? You're selling the lower.
Yes, you're selling, thank you, you're selling the lower and buying the higher. Thank you, Tom. Now, I don't know about you, But in trading school, I'm pretty sure the first lesson wasn't sell low, buy high. Okay.
Well, that's why condors right now are not really the best
and
thing.
why they haven't worked for a year and a half, or why they haven't returned what they had. So when you have a standard condor type of trade, or you're selling put spreads, it's a difficult trade to make money on right now because you have the IVs working against you. Now, what ends up happening is that some people, okay, have done absolutely great because why they've sold puts. It doesn't make a difference, okay, where you sold your puts. You made money. But is it worth it selling a put when the implied volatilities are this low? It's a little bit more challenging, and what ends up happening, we get a pullback, and these people that have been bragging about how great they've done for the last 2 years, they're going to get smoked.
Well, yeah. I mean, if they're averaging, say, a 5% return on a high probability condor in a low vol environment, when that low vol increases to higher vol and even higher vol and stays there, that's the important thing. I mean, there's a difference between a spike in vol that lasts 2 days and then it comes back to the norm. A condor or butterfly, trade can withstand that. But if you have a higher implied vol that stays and sticks there, you're going to be underwater for quite a while. And what's going to happen is you're going to be looking at the downside of your condor, and you're going to start to notice that, man, if we, move another 3 or 4% lower, not only am I going to lose everything I've made for the last year, but I might lose a lot more. And I just think that condors have a really stinky risk-reward relationship in a low-vol environment, period. Higher vol.
And it's a double whammy, right? It's a double whammy for you because not only is the vol low, but the put skew is steep, which means that what you're buying is a much higher vol than what you're selling on the put side. So you get this double whammy, and for the high probability or any type of iron condor that works so incredibly well for so many years and has really faltered during the last 18 to 24 months, it's faltered because the IVs have been so low and the put skews have been relatively steep. It's a very difficult trade to end up making money in that type of environment. When would I go long volatility? I want to see the front month. Now, mind you, I'm showing you this because it's a simple picture. It's 15 minutes late. It's not what I use. I use other systems that show me real time. Whether you use Thinkorswim or IB or LiveVol, whatever system you end up using, you can end up finding the real-time quotes and understand where the implied volatility, where the VIX futures are trading. I will tell you that I've played with different things, and I'm also involved with a couple of ex-Goldman guys on a project I'm working on in Fort Lauderdale where we're looking at exactly this. But I'll tell you, if you want to be long the VXX, you probably don't be long the double, okay, the UVXY. It's a little bit more difficult because of the double leverage. Double leverages are designed to go to zero. We can go over this in another one. But if you're going to end up being long, do it simple. Maybe go long either VIX futures if you don't have a futures account. Go long the VXX when things start to break. When do they start to break? They didn't break, in my opinion, on Tuesday when the market opened. They didn't break, overnight on Thursday or when the market opened on Thursday morning on those sell-offs. I want to see it. I want to see it really move. Okay, and how is it really going to move? We're going to start to move into backwardation. Backwardation means that the front months are higher than the second month. Okay, the second month is higher than, the front month is higher than the second month's higher than the third month, and so on. You get where instead of this thing being 4% in contango, you get this thing to be minus 4%, meaning the front month is 4% higher than the back month. At that point, now you're starting to talk. Now you got
So Jim, basically, to give us the tip-off, we can't just look at, the VIX on a chart and say, hey, it's gone up to 20 or whatever. It seems like it might be going higher. What we really need to look at is we need to look at that backwardation so that once we see the front month and the back month getting like to even and then the front month or the back month starts getting higher than the third month, like right here you've got July, August, September. Once we start seeing that happen, that is probably our best tip-off that big money is going to start either rotating out of certain sectors or they're going to put their money somewhere else or something. So we're going to be expecting a momentum type of decline. Is that right?
I think that's exactly it, because one of the things I was explaining to my son, who's an accounting major at Baruch, the other day, there's a difference between velocity and acceleration. For those of you who had to suffer through engineering school like I did, okay, you end up having to do all your calculus and your derivatives and stuff. But basically, it's not just the change in something, but it's the rate of change. So when the market is going down and there's fear, things need to not only be getting bad, but there needs to be fear that it's going to get even worse. Okay, right. As soon as that, and if it's only some small thing like the second largest bank in Portugal, that fear is going to end up passing relatively quick, versus having every major bank around the world collapse like we were all fearful when Lehman Brothers went down in early September 2008. That was not fear that was just going to pass. Okay, right. That fear was going to be around a while. So you have to take a look at and being able to bring out, if you will, event risk. Yes, the implied volatilities, okay, on the S&P options are going to go slightly up before a Fed announcement, okay, or before some other type of, event that could really move the market. But it's shorter term. It's not an, oh, my God, the world is going to change a type of thing. It's when those things happen that you have to end up really looking at. That's when the VIX or the VXX, if you're going to buy it, will end up moving. In 2008, and I don't know did I share this? No, where was it? Okay.
Hey, while you're thinking, I had one final question about this. Okay, so the VXX itself, Jim, if I were to want to go buy that, okay, is that considered an ETF, or is it considered a futures contract, or is it, can I buy it on margin, or are there options on the VXX? So, like, I'm looking at this chart, and I'm thinking to myself,
here,
okay, certainly at some point, don't know when, just like soybeans at 16-year lows, you know that eventually you're going to have a drought and that thing's going to skyrocket. Now, we don't know when it's going to be. Maybe we could buy the VXX and we could put like for our retirement account, like your retirement account that you're showing how your progression is going to be on capital discussions. I really like that. Now, if I were to use this vehicle, for instance, now I know you can't say for certain, but if I were to, what would be my procedure? Would I actually sort of buy the VXX with a certain number of shares and then just simply, wait for a rise? Or is there something else I should do? Is there covered calls or anything that could, carry you through, a year or two of sideways action?
Okay. Great question. Yes, there are options on the VXX. I'm showing them right now. The challenge with the VXX is because of that, let's call it on average, 2 to 8% per month drag.
Yeah, that's the thing that I'm kind of trying to focus on to understand how that drag. So if you're long it.
Well, here, that's if you're long it. By the way, if you want to short it, you can short it. It's a little bit more difficult to short. Let me see if I can end up getting where can I end up getting? Let me get rid of this one.
Okay, so I think I'm getting a handle on it. Okay, so because of the drag,
what you can do right? If you want to end up shorting the VXX, instead of that, there's the I call it 14, XIV.
Right. Okay.
Right?
I know that one.
Right? And now this is the opposite of it.
Louis the 14th.
Yep. So what did I do with one of my? I also had I had another little IRA, and it had only a few $100s in it. It was a payment, a dividend payment that came in after I transferred stuff out, and so it was a few $100s, and they were going to start to charge me because it was inactive. I even forgot it was there. So what did I do? Earlier this year, I bought 14. Right? I bought XIV. Okay? I bought it at like 33, and it's up at 45 now. This thing will end up going up over time. The problem is, look at what happened here. This was during the 2011, budget scare. If you're in this thing at the wrong time, you can get killed. Now, here's the thing. You can't get killed on this thing as long as you are in contango. Contango says that the front month is lower than the back month. Now, as soon as that front month starts being much higher than the second month, now that 2 to 8% per month drag can become a 10% tailwind. Okay, and the VXX can shoot to the moon, and this is just the opposite of it. It can end up the XIV can get absolutely slaughtered,
down to zero.
And the VXX is basically engineered because of that normal contango and that monthly drag every single month. You will find that it will go to zero. Now, again, the guys that built this thing, they're smart guys, and it's not really, to answer your question, the VXX is really it. I'm going to say it's an ETF with a star. It's not really a true ETF. It's an exchange-traded note. It's not an exchange-traded
Yes,
fund.
right. Yes,
Okay.
I've heard that. Yes.
Okay. Now, here's the problem. An exchange-traded fund actually has the real assets inside the fund, and you can, go to the provider, and if you wanted to, and I've known people that have done this, the arbitrage guys, instead of buying XLF, they might buy all of the components, and they might do exchanges, or redemptions they're called, where they'll trade in their ETF shares for get their individual components, or they'll build the individual components, and then they'll get ETF shares. In an ETN, it's a little bit different. Here, what you're doing is that you're trusting Barclays. They're the guys who built the ETN, by the way. You're
Right.
trusting Barclays. They say, don't worry about it. We got it.
We got it
I'm
covered.
I'm going to sign a note that I've done.
It's an IOU.
It's an IOU. That's exactly what it is. It's an IOU. And they trade the futures underneath, and they're allowed to do anything they want. Now, the thing is, it's arbitrage. The problem was, do you guys remember the VIXI? It was maybe about 2 years ago. What happened was the ETN, they kind of messed up their formula. So they said, we thought, and I don't remember the exact numbers, but they said, we thought it was X, and it's really, X minus Y. It's a lot lower than we thought it was. So here's the new price.
Right.
And the ETN, there's nothing you can do about it.
I tell you what, I have thoroughly enjoyed this conversation. This is, these are the things that me personally, I don't know anything about. I want to learn about these things. And today's session was, I'm glad you guys invited me because I learned a lot out of this. And one of the things it did was it created more questions for me to try to get involved in that, because I do believe the strategy of, the volatility products where they have the drag, the monthly drag, is so plain to see that they have to sell stuff at lower prices and buy stuff at higher prices, that it does push the product down just in a steady fashion. And then once the backwardation, exists, you can see a massive and violent increase there. So I would think that, I mean, obviously this thing could continue to go down, creep down for years. But I would think that if somebody wants to, take a little bit of risk capital and go the opposite direction on that, I think that, well, especially, I mean, you could make money on the way up if you actually are long the product on the way up. Then, once it's way up, go back to the normal procedure of being short the thing, because you know that over the next 3 years, 4 years, it's just going to have the backwardation decay, right? I mean,
the contango decay, exactly. I've read a number of papers. I know that.
Yeah, I get those too.
Right, contango is the normal process when the front months are lower than the back months. Contango is going from lower left to upper right.
Okay.
Backwardation is when there's a lot of fear in the market, and I'd say probably we're in backwardation on average.
And the left is higher than the right. Okay.
And that only happens maybe 5-10% of the time. So what ends up, I've read a lot of papers. One of our partners, OptionView, they have an indicator on it, and I've read through their whole indicator. Read a lot of papers from guys like different options pundits. Larry McMillan had written a whole trading system on it. This is what I've in the process. We're about 3 out of a 4-month process of actually building indicators that we're going to be using, in a trading system with a bunch of ex-Goldman guys that I work with down in Fort Lauderdale. But yes, this is a great way to take a look at things. The other thing we end up taking a look at, and I had built some indicators and wrote charts on stuff on Thinkorswim, ThinkScripts. And if you'd like, what we can end up doing is we can go through a whole show, a whole another WebEx where we can talk about some of the differences of them, because it really is quite fascinating. We hope that you come back and speak to us again, Tony. We'd really like to be able to do this. I hope that you are going to end up putting this, with your Options Element website. For everybody, why don't you tell everybody where your website is if they want to get more information on you?
The website is www.optionelements.com. That's the public site. And then, of course, for our members, we have, our options trading room where we trade our positions live, and we also teach classes. So the information to join us is on the public site. And we also have some free stuff, just like you guys. It's, meant to let people know, if this is the type of thing they want to pursue or not. So I appreciate you guys having me today. This was a very good and good discussion. I really enjoyed this. I'm going to have to go back and review this again and think about it, because it was quite, extensive, but it was great information. So, hey, I want to thank you guys, Jim and Tom. And I guess what I'll do is I'll go ahead and sign off, and you guys can finish up your the video. So would like to be back again, so please invite me.
We definitely
will. Thanks for coming, Tony.
Okay, guys. All right, see you guys later. Enjoy your weekend, by the way.
Thank you, you too.
Thank you, too.
Tom, thanks for setting everything up. And for everybody, this is what we're trying to do. We're trying to form a community in and around options trading, having a very interactive, lively conversations with, some of the members of our community, and being able to help traders and individual investors kind of get their own stuff to their next level in building this in this community. Tom,
exactly.
Anything else you want to add?
No, I think we've gone over quite a bit today, and I hope everybody enjoyed it, and we'll do it again next week.
We'll talk to you guys soon. Bye-bye now.
All right. Thanks a lot. Bye-bye.